Welcome once again. Today we'll be looking into some accounting standards, international accounting standards. If you haven't subscribed to our channel, please do so. Even before we continue, hit the subscribe button and, so that anytime we post videos, you'll be the first to get it. Now let's dive straight into the slides. Today we'll be talking about IAS 16 specifically. Then in subsequent videos, we'll talk about IAS 20 and IAS 40. So let's move on into the slides. IAS 16 is the accounting standard that deals with property, plant, and equipment. Property, plant, and equipment. In this lecture, I'll call it PP&E very often. So please take note of that. So property, plant, and equipment, or PP&E, are tangible assets. When we say something is tangible, it can be seen, it can be felt, it can be touched. It can be touched. PP&E is not intangible, like goodwill. PP&E is tangible, and it is held by an entity for more than one accounting period, right? It is held by an entity for more than one accounting period. That's what makes it a non-current asset. If it's held by an entity for more than one accounting period, it becomes a non-current asset. And it is used in the production or even the supply of goods and services, or even for renting to others. So this PP&E, or property, plant, and equipment, is used to produce other goods or even supply other goods and services, or even used for rental to others. So property, plant, and equipment, number one, is a non-current asset. Number two, it's a tangible asset. Number three, it is used in the production or supply of goods and services, or even for administrative purposes as well. Now let's look at how to recognize it. An item of property, plant, and equipment should be recognized as an asset when, number one, if it is probable that future economic benefits will flow to the entity. So if future economic benefits are going to flow to the entity, then it should be recognized as an asset. Anytime you think of an asset, one of the things you should think about is economic benefits. That's what makes an asset, right? So if it is probable, the key word is probable or likely that future economic benefits will flow to the entity, then it should be recognized as an asset. Number two, the cost of the assets must be measured reliably, or can be measured reliably. If we have that reliable measurement of the cost of the assets, then it should be recognized as an asset. I hope you get the picture. So if the cost of the assets cannot be measured reliably, we cannot recognize it. In fact, how will we recognize it since we do not know, we do not have a reliable measurement of the cost of the assets? That's very, very important. So these two things, future economic benefits and the cost being measured reliably, are two important factors when it comes to recognition. Now let's move on to initial measurements. When you talk about initial measurements, we say that an item of property, plant, and equipment should initially be measured at its cost. Cost, which includes every cost involved in bringing the assets into working condition, every cost that is incurred in bringing the assets into working condition. Very, very important. So any expenditure you make to bring an asset. So let's say if it's, let's say it's a plant and you spend some money to bring it into working condition that's able to work again, that is also part of initial measurements. It also includes initial costs, initial capital costs, such as the cost of the site preparation, like when you're preparing a site to build something on it, or delivery cost, or installation cost, or even borrowing costs. All these costs are included when we talk about the costs. Very, very important. We also have dismantling costs. For dismantling costs, the present value of these costs should be capitalized, right? So maybe you have to dismantle something so that your PP&E can operate very, very well, can operate to this highest maximum potential. So you need to dismantle something somewhere close to it. The present value, we need to calculate the value of that cost today and capitalize it. So number one is the cost you incur in bringing the asset to working condition. Number two is the initial capital cost, which is like site preparation, installation costs, borrowing costs, those kind of capital costs that help, the PP&E to work at its utmost potential possible. Very, very important. Then dismantling cost as well. Dismantling cost. And then what you should know is that revenue cost should be written off as incurred. Now let's move on to subsequent expenditure. Subsequent expenditure on property, plant, and equipment should only be capitalized. You should only capitalize subsequent expenditure for PP&E if it enhances the economic benefits provided by the assets. So for example, if it's a house, maybe you enhance the economic benefit of a house, which is PP&E, for example, by maybe adding extra rooms, adding a bathroom, adding a kitchen, making it into a story building. That's enhancing the economic benefits. So here we say that this could be extending the asset's life, an expansion, or increasing the productivity of the assets. Number two is it should only be capitalized if it relates to an overhaul or required major inspection of the assets. An overhaul. This is very, very key. An overhaul. So if it relates to an overhaul or required major inspection of the assets, subsequent expenditure of such nature should be capitalized. So for example, maybe you have a plant or a multi-unit generator and you have to overhaul the entire system. That should be capitalized. The cost associated with this should be capitalized and depreciated over the time until the next overhaul or safety inspection. So you see, overhaul costs, very, very key. Number three, if it is replacing a component of a complex asset. Now, let's talk about the complex assets. A complex asset is an asset that is made up of different components. If an asset is made up of different components, that's when we call it a complex asset. Subsequent expenditure on PP&E should be capitalized if it is replacing a component of a complex asset. So if there's any replacement of a component of a complex asset, that should also be capitalized. And the replaced component will be derecognized because, of course, it has been replaced. It has been replaced. Very, very key. Now, what is depreciation? Depreciation in simple terms is wear and tear. When wear and tear happens to an asset, that's what we call depreciation. So depreciation is simply the systematic allocation of the depreciable amount of an asset over its useful life. Very, very important. So that's when you say depreciation, that's it. That's what we mean by depreciation. That's what we mean by depreciation. So the depreciable amount is simply the cost of the assets less its residual value. So anytime you want to calculate the annual depreciation charge, the annual depreciation charge will simply be cost minus residual value divided by, and put that into brackets so it's clear for you, all divided by the useful life. So this is it, right? And this is it. So the cost minus residual value is what we are referring to as the depreciable amount. The depreciation method used should always reflect the pattern of consumption of economic benefits. It should reflect fairly the pattern of consumption of the economic benefits. So how the economic benefits of that particular asset is consumed, the depreciation method should reflect it fairly. So we say here that the depreciation method used should reflect as fairly as possible the pattern in which the asset's economic benefits are consumed by the entity. Possible methods include there are several methods, straight line depreciation, reducing balance. Those are the two most famous ones. But there are a lot of depreciation methods. Now let's move on to other issues. Anytime you are changing from one depreciation method to another, right? Anytime you are changing from one depreciation method to another, that can be done, or it is permissible on the grounds that the new method will present, the financial statements more fairly. The new method will give a fairer presentation of the results to the users of the financial statements. So if it's going to give a fairer presentation of the results to the users of the financial statement, we can certainly change the depreciation method. So here we say that change from one method of depreciation to another is permissible only on the grounds that the new method will give a fairer presentation of the results and of the financial position. Also, we need to know that a change from one method of providing depreciation to another does not constitute a change of accounting policy. It's also a change from one depreciation method to another is certainly a change in accounting estimates. It's a change in accounting estimate. Now let's talk about revaluation of non-current assets. IAS 16 allows a choice of accounting treatment for property, plant, and equipment, or PP&E. We have the cost model and the revaluation model. Always keep these two things in mind, So what's the cost model all about? The cost model is simply saying that PP&E should be valued at cost less accumulated depreciation. PP&E should be valued at cost less accumulated depreciation. Then for the revaluation model, PP&E may be carried at a revalued amount less any subsequent accumulated depreciation. So you see the difference here? We are looking at the cost model. We are looking at the cost of the assets, actual cost of the assets. The revalued model, we are looking at the assets in its revalued state. Some assets gain value over time. So the revaluation model looks at the value of the assets in its revalued state. That's very, very important. Let's talk more about revaluation. If the revaluation alternative is adopted, two conditions must be complied with. If you take the revaluation alternative, two conditions must be applied with. Number one, revaluations must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ from the fair value at each reporting date. So what does this mean? Revaluations must subsequently be made with sufficient regularity. You should be using the revaluation method often so that the carrying amount does not differ from the fair value at every reporting date. You should subsequently continue using the revaluation model and using it with sufficient regularity. Very, very key. Number two, when an item of property, plant and equipment is revalued, the entire class of assets to which the item belongs must be revalued. So when an item of PP&E is revalued, the entire class of assets to which the item belongs must also be revalued. It's fair, right? Because you can't be using several methods, when the assets belong to the same class. So when an item of PP&E is revalued, that entire class must also be revalued. Very, very key. So these are the two conditions. Now let's look at accounting for a revaluation. Accounting for a revaluation. How do you account for a revaluation? Seems quite interesting. Number one is you have to restate the assets cost to the new valuation, right? So maybe the cost of the PP&E was initially, of a plant was initially $15,000. of a house was $15,000. Now, the actual value is $25,000. So you have to restate the assets cost to the new valuation. You have to eliminate any existing accumulated depreciation for the asset, number 2. And number 3, you need to show the total increase in other comprehensive income at the foot of the statement of profit or loss. This will then be taken to the revaluation surplus. Very, very key. Very, very key. So as you go through the journals, you understand exactly how this works. And when we say this will then be taken to the revaluation surplus, it's just like profit for the year gets to retained earnings. So this is the journal. This is the journal for when it comes to accounting for revaluation. First of all, you debit non-current assets, right? So you debit non-current assets, which is the revalued amount. You debit accumulated depreciation. You debit accumulated depreciation, which eliminates the accumulated depreciation balance. Then you credit other comprehensive income, which is the revaluation surplus. Very, very important. Very, very important. You debit non-current assets costs or valuation. You debit accumulated depreciation, which eliminates the accumulated balance, right? Which eliminates the accumulated balance. Then you credit other comprehensive income. Other comprehensive income. That's very, very crucial. Very, 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 very crucial. Very, very crucial. Then let's look at recognizing revaluation gains and losses. Revaluation gains are recorded as a component of other comprehensive income, either within the statement of profit or loss, right? Either within the statement of profit or loss and other comprehensive income, or in a separate statement. So revaluation gains are recorded as a component of other comprehensive income. We know this from basic accounting, that revaluation gains are a component of other comprehensive income. This gain is then carried in a revaluation surplus within equity. This revaluation surplus is a capital reserve and is therefore not permitted to be distributed to shareholders. Revaluation losses. Revaluation losses, which represents an impairment, right? Which represents an impairment of the asset value, are recognized in the statement of profit or loss. When a revaluation arises on a previously revalued asset, it should be deducted first against the previous revaluation gain and can therefore be taken to other comprehensive income in the year. Very, very key. These are very, very important principles. Now, I want you to take note of something. When you look at revaluation gains here, it says they are recorded as a component of other comprehensive income. Now, when you come to revaluation losses is simply an impairment of the asset value, right? They are recognized in the statement of profit or loss. So you see the difference? Please watch the difference very, very carefully. Revaluation gains are recorded as a component of other comprehensive income. Revaluation losses are recognized in the statement of profit or loss. Very, very key. Very, very key. So you should know where revaluation gains go to, and you should know where revaluation losses go to. This is something I wanted to point out to you. Let me underline it so that it's very, very clear to you. I recognize in the statement of profit or loss. That's revaluation losses. Then revaluation gains. Let's go up. Revaluation gains are recognized as a component of other comprehensive income. Now, this is very, very, very important. Very, very, very important. So always know that difference. Please keep that difference in mind. Now, let's look at this illustration. Let's look at this illustration. Very, very basic illustration. An entity revalues its buildings and decides to incorporate the revaluation in its financial statement. Now, extract from the statement of financial position at 31st December 2007. So the building cost is 1,002 and the depreciation is 144. The difference is 1056. The building is revalued at 1st January 2008 at 1.4 million. Its useful life is 40 years at that date. At that date. So show the relevant extracts from the financial statement. So let's look at how the extracts will look like. First of all, you need to know that depreciation will find itself, depreciation expense will find itself in the statement of profit or loss. In the statement of profit or loss, right? So another thing we should also know from this is that we are looking at the revaluation of non-current assets. The revaluation of non-current assets. So let's dive into how the solution will look like, right? So you have, first thing is that we need to know the depreciation amount. This depreciation amount. What is it going to be? This depreciation amount. First of all, we know the valuation of the assets. The valuation of the assets is 1.4 million. 1.4 million. Very, very important. 1.4 million. That's what the asset is valued at. It's valued at 1.4 million. Then the estimated useful life here that we are told is 40 years. When you divide 1,004 by 40, you get 35. 35. So you see, the building is revalued at 1st January at 1.4 million. Its useful life is 40 years. So here we are not given a residual value. So you divide 1,004 or 1.4 million, 1.4 million or 1,004. Let's take the zeros out. Divided by 40, it should give you 35. It should give you 35. So that's the 35 that the solution is presenting to us right here. 35, right? So you see, 35, that's the depreciation charge, 35, okay. So now that will be our depreciation expense, 35. Because depreciation is an expense, so it will be minus 35 or into bracket 35. And depreciation expense will go in where? Into the statement of profit or loss, right? Into the statement of profit or loss. Now we need to find out if there were any gains or losses on revaluation. Were there any gains or losses on revaluation? So let's check it out, right? Let's check it out to see. Maybe there were some gains. Who knows? Who knows? But how do we calculate that? How do we find that out? How do we find that out? Were there any gains? Were there any gains? Okay, so to calculate, so there was certainly a gain. If you look at the revalued amount, it was 1.4 million, right? If you look at the net book value here, it's 1,156,000. So let's do a simple calculation and see what that gets us to. So equal to 1,400 minus 1,056 is equal to, I think, 344. If I'm not mistaken, I hope my math is correct. So 344. So that's 344. That would give us 344 would give us it's actually a gain because the revalued amount was higher than, the net book value of the assets, So let's see if you are right. Yes, 344. And since it's a gain on revaluation, remember, it would go into our other comprehensive income. Let me show you this. We talked about this earlier. It says revaluation gains are recorded as a component of other comprehensive income. A component of other comprehensive income. Please keep that in mind. A component of other comprehensive income. So that is very, very crucial. Very, very crucial. Very, very crucial. So in the statement of profit and loss and other comprehensive income, in this extract, the depreciation expense will be 35,000. Your gain on revaluation will be 344,000. Amazing. Now let's move on to the balance sheet or the statement of financial position. Your statement of financial position, you would have PP&E or land and buildings, right? Land and buildings. Very, very important. Now for your land and buildings, how do you calculate this? How do you calculate this? First off, you know that your revalued amount was how much? 1.4 million. Then you know that you have depreciation of 35,000, right? So let's go back to the question. See, the revalued amount is 1.4 million. When we calculated our depreciation, it was 35,000. So 1.4 minus 35 should give us, I think, 1365. Yes, 1365. 1365. So that would be, the net book value of PP&E. Let's see if we are right on that. Let's see if you are right on that. And the 35,000, remember, is the depreciation expense, which we already calculated. Is this the depreciation expense? So yes, we are right. So 1365. Very, very key. Then once you need to also know that the revaluation gain also goes into equity as well as revaluation surplus. It's revaluation surplus, which is 344. So basically, this is how you do your recognition, right? In your statement of profits or loss, you need to have depreciation expense as well as depreciation expense. And your other comprehensive income, you need to have your revaluation gain. In your statement of financial position, you need to have the revalued amounts less any accumulated depreciation in your PP&E balance, and in your equity, you should have your revaluation surplus, which is your revaluation gain in your equity position. Very, very key. Very, very key. Very, very key. So always remember that. Always remember that. Always remember that. So if you realize in the question, right, our revaluation surplus was also in equity, So we already discussed this and we said that this gain is then carried in a revaluation surplus within equity. Within equity. So you see, everything is tying out very nicely. Within equity. So that's very, very important. So I thought I should bring that to your attention. Now let's move on to depreciation of revalued assets. The depreciation of revalued assets. Once an asset has been revalued, the following treatment is required. Depreciation must be charged based on valuation less residual value over the remaining life of the useful assets. The whole charge must go to the statement of profit or loss for the year. And an annual reserve transfer may be made from the revaluation surplus to retained earnings for additional depreciation charge on the revalued amounts compared to costs. This permitted treatment under IAS 16 is to replace is to address the imbalance between a non-distributable gain held in revaluation surplus and the reduction in retained earnings due to the increased depreciation charge. This transfer will be shown in statements of changes in equity. So what are we saying here? Depreciation of revalued assets is basically how you depreciate, similar to how you depreciate an asset based on costs. The depreciation must be charged over the remaining life of the useful asset, and the whole charge must go to the statement of profit or loss for the year. An annual reserve transfer as a result may also be made. So that's essentially what we are talking about. That's essentially what we are talking about. Always remember that any revaluation surpluses go into would go into equity. Now let's look at some journals, right? Let's look at some journals. So first of all, you debit your statement of profits or loss with the depreciation charge, and you credit accumulated depreciation. And you also debit your revaluation surplus. And credit retained earnings. These are two main journals that you need to keep in mind. You debit your statement of profit or loss with a depreciation charge and credit your accumulated depreciation. And you debit revaluation surplus as well and credit retained earnings. How do you dispose of revalued non-current assets? The profit or loss on disposal of a revalued non-current asset should be calculated as the difference between the net sales proceeds and the carrying amount. So for a revalued asset, the profit or loss on disposal is simply the difference between the net sale proceeds and the carrying amount. There are two steps to disposing of a revalued asset. Number one, it should be accounted for in the statement of profit or loss. These are the two ways. So it should be accounted for in the statement of profit or loss, or any balance on the revaluation surplus relating to this asset should now be transferred to retained earnings. See what is happening here? Number one, it should be accounted for in the statement of profit or loss, or the revaluation surplus balance should be transferred to retained earnings. Very, very key. So these are the two ways you handle disposals. Very, very crucial. Very, very crucial. We already talked about the journals, right? So that's something you need to keep in mind, right? Let me go over the journals again. Number one, you debit the statement of profit or loss with the depreciation charge. And number two, you credit accumulated depreciation. That's number one. We said that there are two ways. So let's go back and let me show you the two ways. The first one is what? It should be accounted for in the statement of profit or loss. Right, so you debit the statement of profit or loss with the depreciation charge and credit accumulated depreciation. The second one, which we are told here, is that any balance on the revaluation surplus relating to this asset should now be transferred to retained earnings. So you debit revaluation surplus and credit retained earnings. So this is quite, I hope this was quite helpful. Thank you for listening. If you haven't subscribed to this channel, please do so as we continue this journey on international accounting standards. Thank you and have a good day.